Senator Rounds of South Dakota.
Thank you, Mr. Chairman. Chairman Powell, first of all, it's good to see you again and appreciate your service to our country as well. Thanks for being with us today. I'd first like to ask about the SLR exclusion, which is set to expire on March 31st. My colleagues have mentioned it earlier, but did not really get into the heart of the matter. The temporary patch allowed banks to exclude ultra-safe assets, U.S. Treasuries and deposits at the Fed, from their balance sheets. This was important in preserving bank liquidity during last spring's flight to cash, and was common sense move since the Fed can't go bankrupt and the Treasury has never failed to meet its obligations. We all agree that the economy is still in need of fiscal and monetary support. The chairman himself said that banks should be doing more to help their workers and our broader society, but they can't do that when we're tying their hands with excessive and challenging capital requirements. It would appear Congress is going to create even more bottlenecks in our financial plumbing by flooding the economy with about $1.9 trillion in new money that banks will have to hold capital against as soon as the Treasury starts writing the checks. My question is, would you agree that it makes sense to seriously consider extending the SLR exclusion, given the other measures the Fed and Congress are taking to facilitate our economy's recovery?
So I do think that the SLR exclusion, I know that it expires at the end of March, and we actually haven't made a decision on what to do. It's something we're in the middle of thinking about right now. And so I'm just going to have to say that we'll be making a decision and announcing that pretty soon here.
I think the reason for my question is that I think last time around and in the past, we've had challenges with banks that have come in and said, look, we've got folks that want to bring their assets in. They've got to have a place to put it. It is liquid. It's what we're going to have. Most certainly that has impacted our ability and the reason for the SLR in the first place. And it just seems to reason that as you talk about it and as you continue to discuss it, I hope that we really do keep an open mind, and I presume you are keeping an open mind on the need for that, as this amount apparently will be put into the economy in very short order. And so I simply bring it up as saying I think there's a lot of us that think that that's going to be an important part of the discussion to have. Let me lead into another question with you, sir. We've been monitoring the increase in Treasury yields from about 0.9% at the start of 2021 to approximately 1.37% when the market closed yesterday. I understand that this reflects a view of an improving economy, but also comes with increased borrowing costs, increased inflation, and potentially a move by the Fed to increase interest rates down the line. How do you view the increase in Treasury yields in the broader context of our economy at this point?
So first, we look at a broad range of financial conditions, and that's one. It's an important one, but really we look at the whole range of financial conditions, and it's very important to ask, why are rates moving up? And so if you look at why they're moving up, it's to do with expectations of a return to more normal levels, more mandate consistent levels of inflation, higher growth, an opening economy. In a way, it's a statement of confidence on the part of markets that we will have a robust and ultimately complete recovery. So those are the reasons that are behind it, that are behind that move, I would say.
Great. Well, look, thanks. We follow the markets. We follow on a regular basis whether the markets are moving up, they're moving down, and so forth. And I think in anticipation of what your thoughts were going to be today, I think the market was rather volatile. I'm just curious, when you walk into an opportunity like this where you're sharing your thoughts, I know that you want to be very careful in terms of the message that you send, and I think you do a very good job of being very careful in the way that you send the message. But let me just ask, in your opinion, when you prepare for this type of a discussion, knowing the markets are literally watching everything you say, what's the message that you'd like to send? Are you talking, we're going to have stability, it's going to be steady as she goes, we don't see changes coming up with regard to the availability of capital, we don't see changes that are going to impact inflation? What's the message that you really want to send as you share with us today and you're expected to be in front of our committees?
So I guess I'll say a couple things. First, the starting point is that we're 10 million jobs below where we were in February of 2020, 10 million payroll jobs. So there's a long way to go, and many of those jobs are concentrated in the lower end of the income spectrum, as I mentioned. Many parts of the economy have recovered, but in the bottom quartile, the unemployment rate is probably in excess of 20%, we think. So there's a long way to go. And monetary policy is accommodative, and it needs to continue to be accommodative. We've put forward guidance out both on our asset purchases and our rates. We think that that forward guidance is appropriate, and you can expect us to move patiently over time as we see better data coming in. You know, right now we've had 3 months of 29,000 jobs a month. It's not very much progress. We expect that such progress, which we had earlier last year, we had very fast progress. We expect that that'll begin to return in coming months, and expect us to move carefully and patiently and with a lot of advanced warning.
Shepard Smith here. Thanks for watching CNBC on YouTube.